How did an exchange lose $32 billion? How did it disappear so fast, and who was responsible? This is the story of FTX's collapse, a rise, risky bets, and a sudden run. In days, fortunes evaporated, withdrawals blocked, panic spreads. From startup to industry titan, then collapse. Sam Bankman-Fried, the face of FTX. This is how $32 billion vanished. We start at the beginning. FTX launched and grew rapidly, a crypto exchange for the masses. By 2021, Sam was on magazine covers and hailed as the next big founder. User volumes surged. FTX climbed into the top 2 global exchanges. SBF cultivated a trust brand, accessibility, philanthropy, and a nerdy public image. He promised safety and innovation. Customers poured in. Behind the brand, one platform, complex tech, and growing liquidity. Investors poured capital. Valuations soared into the billions. FTX launched tokens, derivatives, and its own token, FTT. Traders liked the features. Liquidity deepened, at least on paper. But underneath, complex arrangements were forming. And one company, Alameda Research, became tightly linked to FTX. The rise set the stage for risky finance. FTT was FTX's native token, used for discounts and as collateral. But FTT was also used as supposed collateral for loans. On paper, balance sheets showed assets, but many were illiquid or tied to FTT. Alameda borrowed against FTT, creating concentrated exposure. When collateral is illiquid, leverage magnifies risks. Analysts later showed heavy concentration of FTT on Alameda's books. A sharp drop in FTT value could wipe out collateral quickly. But much of this wasn't transparent to outside users. Experts warned about concentration and opaque collateral. 3 factors. 1. FTT as collateral. 2. Concentration at Alameda. 3. Heavy leverage. Together, they meant the system could break quickly. Risk was concentrated, obscured behind tokenomics and related party deals. Next, how Alameda and FTX's balance sheets intersected, and where the hole opened. From 2020 to 2022, transfers between FTX and Alameda grew regular. Reports later alleged backdoor transfers of customer funds to Alameda. Balance sheet gaps appeared. Assets overstated, liabilities understated. Journalists and leaked documents began to connect the dots. Alameda's exposure was tied to FTT and to FTX's customer base. When liabilities grew, the assets were not sufficiently liquid. A hole opened. Key events: a major funding round, a large loan to Alameda, then internal transfers. The mechanics were technical, but the effect was simple. Liquidity levers were stretched. Audits later estimated a tens of billions shortfall in customer-accessible assets. As withdrawals rose, the hole widened. Assets could not cover claims. Customers noticed trouble and began pulling funds. By late 2022, the transfer pattern and FTT dependence created an acute liquidity risk. Exposures became public, confidence faltered, the hole was now visible and dangerous. Then FTT's value plummeted. Confidence collapsed. Withdrawals spiked as customers rushed for exits. Support lines jammed, confirmation screens failed. On the back end, liquidity engines couldn't reconcile obligations. Assets no longer covered liabilities. A solvency crisis. Mainstream media called it a collapse. Regulators took notice. In hours, markets convulsed. FTX's public image fractured under the weight of numbers. By November 2022, everything shifted. Executives scrambled, lenders pulled back. The math: billions frozen, customer claims mounting, trust gone. Across the world, retail traders watched savings vanish. A scramble ended in bankruptcy filings. FTX filed for bankruptcy in late 2022. The filing revealed a complex maze of claims and creditors. Sam Bankman-Fried faced legal scrutiny and eventual charges. Court proceedings unpacked transactions and alleged misconduct. Victims and regulators called for accountability. Policymakers debated new rules for custody and transparency. Over months, investigations, asset recoveries, and indictments followed. Trustees recovered some assets, but large shortfalls remained. Complex insolvency proceedings stretched across jurisdictions. Customers spoke of lost access and uncertainty. Regulators proposed 1. Clearer custody rules. 2. Improved transparency. 3. Limits on asset use. The trial became a focal point for accountability in crypto. The collapse reshaped the industry's rules and reputation. What did we learn? First, custody matters. Keep customer assets segregated and auditable. Second, transparency. Opaque tokenomics and related party deals hide risk. Third, leverage can turn small losses into systemic failure. Limit concentration. For more investigations, subscribe to FraudLine. Watch our playlist, Finance Scandals.